take in order to achieve its objectives. We're now going to start to look at some of the detail of a particular decision, the financing decision. This decision is specifically identified in the overall syllabus, where we can see it identified for 30% of the total marks. Over the next few chapters, we're going to look at various different sources of finance before finally discussing what the appropriate balance might be. This chapter looks at equity finance, and in this chapter we're going to focus on the types of equity finance, how you might get hold of equity finance, and then finally, towards the end of the chapter, we're going to start to look at some of the formulae involved in calculating the cost of equity finance. Okay, let's start off by defining a few terms. Ordinary shares are a type of share capital whereby shareholders have the right to vote at the AGM and thereby to exercise some control over the way the company is being run. In exchange, they'll be entitled to dividend payments, but the amount of dividend is at the discretion of the board of directors. We're going to focus on ordinary share capital as we go through this chapter, and when we talk about equity finance, this is what we normally mean. The other type of share capital that we'll look at here is preference shares. And with preference shares, shareholders receive a fixed amount of dividend but have no right to control the way the company is being run. And so when we talk about equity finance, we don't actually mean preference shares. Preference shares are discussed in this chapter because they're a type of share capital. But when we start to talk about debt finance in chapter 6, in fact, preference shares are normally referred to as a type of debt finance because they involve the payment of a fixed amount of dividend. Apart from raising further finance from your ordinary shareholders, another source of equity finance is to approach a venture capital organisation, such as 3i, who are actively interested in taking high risks by investing considerable sums of money in companies with often global ambitions, very high growth potential. And in return, 3i are looking to make very high returns for their shareholders of up to 30% per year, which they'll obtain by selling the shares and hopefully realising a capital gain. Now, venture capital is an area where you're expected to be able to discuss the reasons why a company might approach a venture capitalist, so let's have a look at 3i in a little bit more detail. 3i specialise in a number of areas, including clean technology, healthcare, in other words biotechnology, and information systems. So if you are a company with global ambitions in an aspect of any of those areas, you can go to 3i and not only obtain a source of finance, but also business expertise. 3i will often put a director onto the board that can advise on business strategy, financial controls, and also use their contacts to obtain valuable relationships with key stakeholders, such as suppliers and customers. So venture capital organisations are not only a source of finance, but also a very powerful business partner. Venture capital can be a particularly expensive source of finance because venture capital is often provided on condition of equity ratchets, where an equity ratchet involves the free transfer of shares from the original shareholders to the venture capitalist in the event that the company underperforms and fails to hit the performance targets that the venture capitalist has imposed as a condition of providing finance. Okay, we're now going to return to the idea that you can raise equity finance from your ordinary shareholders. Although, as we note at the beginning of section 2, a company will not have to do this if it already has cash. So if you already have cash in your bank accounts, and by using that cash you're using your shareholders' funds, and so you are using equity finance, but you're not having to raise ordinary share capital in order to do that. When you're raising large amounts of money, you're likely to have to go back to your shareholders and raise funds. And when you do this, you have a legal obligation in the UK to go back to your original shareholders and give them the right to put more money into the company, and by doing so to maintain the level of control that they have. We'll consider the mechanics of rights issues in a moment, and it is an important area. If your shareholders do not have the funds to make a rights issue feasible, then you're entitled to go beyond your existing shareholders and put more shares in issue. The two main ways of doing this, if you're a listed company, are first of all to go to a big institutional shareholder and to give them a block of your shares. Typically that will mean giving them an attractive price because you're giving them a lot of shares, and they will simply buy those shares and exercise quite a big amount of control and influence over your company as a result. The alternative is to advertise to the general public that they can buy your shares at a fixed price and to wait for applications to roll in. This is more expensive because of the advertising costs, and also because generally you'll go to a merchant bank who will guarantee that the shares will be bought, and in the event that they're not, the merchant bank will buy them. Underwriting costs are generally very high. Very occasionally, and for very high profile share issues, the public are given the right to buy shares at a number of different prices, and the company will then analyse the applications to work out the highest price at which it can raise the funds that it's looking to raise. This is an offer for sale by a tender and is quite rare. Now let's focus on rights issues. In the exam, the most likely way that rights issues are going to be examined is by asking you to calculate the terms of the rights issue. When you go for a rights issue, you normally give your shareholders a discount to encourage them to buy the shares. In some cases, this discount can be very high. For example, Pernod Ricard, in their rights issue in April 2009, offered their shareholders a 36% discount to the existing market price to encourage them to take up the rights issue. In the exam, a discount of close to 20% would normally be expected. That's more typical. And that's pretty much what we're doing in the lecture example, where we're offering a discount of 18% on a market price of £2. So our shareholders have the right to buy new shares for £1.64. And because we want to raise £164 million, that means we require 100 million new shares. Given that there are currently 500 million shares in issue, this would be described as a 1 for 5 rights issue. If you own 5 shares, you've got the right to buy 1 new share for £1.64. This would be the terms of the issue. Because we're issuing new shares at a discount, there is the risk that the share price will go down after the rights issue. The price after the rights issue is called the theoretical ex-rights price. We can calculate it here. Before the rights issue, the company had 500 million shares at £2. It then raised £164 million. This means that after the rights issue, there will be 600 million shares, and the company should be worth approximately 1,164 million. So to work out the theoretical ex-rights price, we can just take the 1,164 million, divide by 600 million shares, and that will give us £1.94. So we can see that the share price has here gone down from £2 to £1.94. The £1.94 is the price of all the shares after the rights issue. You'll see in lecture example 1 that there are some formulae that you can use to develop these numbers. The formulae are given on the formula sheet, but actually they're quite complicated, and as you can see, there's no need to use them here. Sometimes in the exam you're asked to demonstrate whether this fall in the share price would damage the wealth of a shareholder. So in part C of the example, we look at a shareholder who owns 10,000 shares, and we consider whether their wealth would be damaged because of the falling share price. So before the rights issue, the 10,000 shares were worth £2, so their wealth was 20,000. Because it's a 1-for-5 rights issue, the 10,000 shares entitle you to buy 2,000 more shares. But we're told in this example that we can only afford to buy 1,000 of these. So, after the rights issue, we will have 11,000 shares, and we know that these will be worth £1.94 from part B. So shareholder wealth looks like it's gone up, but of course we had to buy those 1,000 shares. And when we bought them, we paid the discounted price of £1.64. And so it does look like our shareholder wealth has gone down. However, we now need to consider the other 1,000 shares that we had the right to buy but couldn't afford to buy. We can sell the rights to buy these shares for £1.64, and the right to buy the shares for £1.64 will be of some value because the share price after the rights issue is expected to be £1.94. The difference between those two figures is 30p. So we should be able to raise £300 by selling these rights, and these can be sold on the stock market, and we should raise about £300. And so our shareholder wealth, as we can see, will not be damaged by giving some money to the company in the form of a rights issue. This is theoretical. In fact, our shareholder wealth could be damaged if the company misuses the funds, and that's what we're going to go on to consider in the next lecture example. Sometimes the funds raised from a rights issue can be used to dramatically increase shareholder wealth, and sometimes the reverse could happen. The price after the rights issue, the ex-rights price, can sometimes be adjusted for the yield that you expect from the funds that you've raised. The yield adjusted ex-rights price can be calculated in two different ways. We'll look at one of these with the lecture example and then discuss the other. From the previous lecture example, we know that we're raising 164 million. But if we're then told that we're going to get a higher return than expected on those funds, then we could suggest that the 164 million will actually be worth 218.67 million. So after the rights issue, the company will be worth the 1,000 million that it was worth before, plus the 218.67 that we just calculated. And if we take that new value and divide by the number of shares in issue after the rights issue, then we can predict the share price will actually go from £2, which is what it was before the rights issue, up to £2.03. And that increase reflects the extra value that we expect to get from the funds that we're raising. If in the previous lecture example you'd been told instead that the project that was going to be developed by the proceeds of the rights issue was going to give an NPV, a net present value, of 54.67 million, then you would have worked out the same yield adjusted ex-rights price by taking the original value of the company, its market capitalisation, adding on the proceeds of the rights issue, which we know to be 164 million, and then adding on the net present value of the project. Divide by 600 million shares in issue, and again that will give you £2.03.
Clearly, if you're listed on a stock market, it will make it easier to obtain equity. And in recent exam sittings, you have been asked to talk about the motives for a stock market listing, but also the mechanics of actually obtaining one. And this is what we're going to review here. We'll take the example of Sports Direct, which obtained a stock market listing in 2007. Generally, to obtain a stock market listing, you need to have 3 years of successful trading, profitable trading. There are some exceptions to this. So if you're a scientific research-based company or a project-based company like Eurotunnel, then you can be exempted that rule. But generally, the main market is not going to be for startups as a general rule. A listing on the main market will mean that you have to comply with the combined code. You're not going to go into details of that in this paper, but 50% of the board being non-executives, having good, strong, independent non-executive directors at board level. And finally, at least 25% of the shares have to be outside of the control of the directors, in other words, in public hands. Now, if you can satisfy those requirements, you potentially can take all of the advantages of a stock market listing. The advantages of a listing are going to include having a higher public profile. So Sports Direct was really brought to the public's attention when it went for its stock market listing. Because as a listed company, you have to have audited accounts, regular stock market briefings, independent non-executive directors, then you're going to have high investor confidence, and that will mean that they'll pay a lot to buy the shares in the first place. And then if you want to expand around the UK, it's not all going to be using the funds of the main shareholder, Mike Ashley. And indeed, it allows the main shareholders to sell some of their investment as and when they wish. And because they then are involved with a listed company, you can increase your use of share options or share awards for senior staff to encourage staff loyalty and to motivate. You can also, as we'll see later in the course, issue your shares when you want to take over another company. So there are some powerful advantages of being listed. There are going to be some disadvantages too. Although the main stock market does allow you to raise finance, it allows you to do it in quite a costly way. The administrative cost of raising capital on the main market can be expected to be about a third of the capital raised. In addition to that, you'll have the membership fees, the compliance costs in terms of complying with corporate governance in particular, pressure for short-term profits and dividends, and you become a takeover target. The process of getting a stock market listing is important. In February 2007, Sports Direct approached Merrill Lynch to be their sponsor. The sponsor will normally be an investment bank, and they'll give you advice on whether to go for a placing or an offer for sale. And the advice was to go for an offer for sale, as it was felt that you'd get a better price and a more diverse share ownership. The suitability of directors, and Merrill Lynch advised there that new directors were needed, in particular a new and more experienced finance director and a new HR director. Merrill Lynch then produced a prospectus outlining the background of the directors, the company's plans, and this prospectus is used as a marketing document. Merrill Lynch also advised on the issue price, initially advising on a range of between £2.50 and £3.10, and then after the broker, which in this case was also Merrill Lynch, had spoken to potential investors, eventually deciding on an issue price of £3. The sponsor is often the broker, and they'll talk to investors, they'll do roadshows around the country, and they'll market the issue of shares to the new investors. Finally, on impact day, the final prospectus agreeing that the issue price to be offered was £3.10 went out, and after 2 weeks Merrill Lynch had managed to assess all of the offers. They'd realised that the demand for shares far outweighed the supply, and shares were allotted, with each investor receiving about half of what they'd subscribed for. That gives you an idea of the process of obtaining a listing, and it is important that you can comment in no more detail than this on it. The alternative is to go for a listing on the alternative investment market, and this will be cheaper and will have far fewer compliance regulations. For example, there's no need to comply with any set corporate governance regulations, but it's less prestigious, and because there are fewer controls, investor confidence will be lower and the shares will be bought by investors at a lower price. So there's a trade-off to be considered there.
One of the important considerations when looking at equity finance will be how much it costs. Shareholders know that when they put money into a company, they run the risk of getting nothing back. So they'll only put money in if they expect a good return. The return that they expect can be calculated in 2 ways. The first method, the dividend growth model, involves the use of formulas, and the best way of building an understanding of these formulas is to look at a lecture example. But you should note that these formulas are given. You do not have to learn them. If a company fails to provide the return that's expected by its shareholders, then its share price will fall. And clearly, as we've said in the earlier chapters, the objective of financial strategy is to maximise shareholder wealth, so we don't want that to happen. Okay, so let's start to have a look at the formulas. In lecture example 3, a company has just paid a dividend of 60p, and the market's expecting dividend growth of 8%. So in 1 year's time, the next dividend that's expected to be paid will be 64.8p. This 64.8p is referred to in the formulas as D1, dividend in 1 year's time. The price that's being paid for the share is £5.50. That's the price today, P0. And the growth rate of 8% is referred to as G in the formula. 8% is 0.08. From this information, we can estimate that shareholders, after paying £5.50 for a share that's expected to give a return of 64.8p in 1 year's time, plus a further 8% return in the form of further dividend growth in the future, are expecting in total a 19.8% return on these shares. So this is our first way of calculating the cost of equity. The same formula is also given as D0 times 1 plus G instead of D1. D0 is the dividend that's just been paid of 60 pence, and we calculated 60 pence times 1.08 is 64.8 pence. It's the same formula. You can use whichever variant you prefer. This formula suggests that shareholders in this lecture example are expecting a 20% return. That's quite high, and it would make you think twice about using equity finance. You'd also want to make sure that any investments that you undertook gave a satisfactory return, bearing in mind what shareholders are looking for. We'll consider that aspect later in the course. There are a number of limitations with the formula that we've just used. The formula assumes that companies are paying a dividend. We know from earlier in the course that some companies will not pay dividends. The formula can also only be used if the company has a share price. But even if a company is listed and is paying dividends, there's one further drawback, and that is that to use the formula, we actually have to estimate dividend growth, which will always be approximate, and whatever estimate we come up with, we assume it's constant forever. These are quite serious limitations and have led to another model for calculating the cost of equity being developed. Let's have a look at how you might have to estimate the growth rate in the exam. The growth rate in dividends is often given in the exam, but if you have to estimate the growth rate, there are two methods that you need to know. First of all, you need to be able to assess the historic dividend growth rate, and then you could assume that that's going to continue for the future. Secondly, you can look at the level of reinvestment that a company is undertaking and the expected returns on those investments, and use that to estimate the dividend growth rate. Which method you use will depend on what information you're given in an exam question. But as we've already said, dividend growth will often be given in exam questions. The next lecture example covers both of these techniques. In part A of the lecture example, we look at the historic growth technique. With this technique, you will typically take the latest dividend that's been paid and compare it to the earliest dividend that's been paid. Here, the earliest dividend was 4 years ago. We then need to work out how we've got from 30 pence to 39.25 pence. So what annual growth rate will have been multiplied to the 30 pence each year for 4 years to get us to 39.25. So dividing both sides by 30 gives 1.3083, and then taking the 4th root of both sides, or if you prefer taking 1.3083 to the power of a quarter, that would suggest that 1 plus g equals 1.0695, and therefore g equals 0.0695. So with this technique, we are taking the latest dividend, comparing it to the earliest dividend, and then either taking the nth root or to the power of 1 over n, where n is the number of years that we're looking at. Once we've got the growth rate, we put that into the formula that we've just seen, where the share price is £8.31, the growth rate is 0.0695, but then don't forget that D1 will be 39.25, but then multiplied up by 1.0695, so that it's the dividend in 1 year's time. and so this will deliver a cost of equity of 12%. So this is the technique that you'll need to use if you're estimating dividend growth using historic data. But if you're not given historic data, you'll have to look at the amount of money that the company is reinvesting to guess the growth rate. In part B of the example, we're given a situation where there's no historic dividends to use to estimate historic growth. Therefore, we have to look at the reinvestment levels of the company. Here we're told that the company has paid out half of its profits as dividend, so the other half has been reinvested. On these funds, we're told the company is going to generate a return of 30%. And we can therefore estimate that the company, if it only grows because of this reinvestment, will have profits growth and therefore dividend growth of 15%. This is summarised in the formula B times R, where B is the balance reinvested and R is the return, and that is a formula that you need to learn. And then if we use the formula as before, inputting the share price and the dividend and the growth rate, then you should estimate the cost of equity to be 33.4%. There's another way of estimating the cost of equity. This uses the capital asset pricing model. With the capital asset pricing model, we make the assumption that a rational investor would build their investment portfolio across a wide range of different types of shares. So for example, you might start off by investing some money in Tesco, and then to reduce the risk of Tesco's strategy failing, you might invest some money in a rival like Sainsbury. And then to reduce your risk of exposure to the UK supermarket sector suffering, you might invest some money in British Airways. British Airways is affected by the oil price rising, and so you might put some money into Shell, which will benefit if oil prices rise. By building a portfolio, you can reduce your exposure to a particular share doing badly because its strategy fails. You can diversify away unsystematic risk to a very high level by investing in above 12, 15 shares, something like that. Once you've reached that sort of level, you've got a diversified portfolio, and your main risk then is that the stock market falls. This is called systematic risk. Each share within your portfolio will behave differently if the stock market falls. Some of your shares will be very sensitive to stock market downturns and some won't. It's possible to measure historically how sensitive some shares are to stock market downturns. Over a 5-year average, various databases monitor the average fall in the return on a share as the stock market falls, say by 1%. This measure is called a beta factor. A beta factor of 1 would mean that your share on average fell by 1% when the stock market fell by 1%. So it would be said to be fairly average risk, and your shareholders would expect a fairly average return. If shares on average fell by more than 1%, they're higher than average risk, and you'd expect a higher than average return. And if beta factors fell by less than 1%, less than average risk, less than average return. Let's have a look at a few real companies here. Okay, taking as an example Ryanair. Ryanair, if we do a quote on the Financial Times website, has got a beta of 0.45. So that's telling us that if the stock market goes down by 1%, Ryanair goes down by about half of that on average. And that's going to be a reflection of Ryanair's competitive position by positioning itself as a very low cost provider, it's not going to do as badly during times of stock market downturns, and so it will be seen as quite a low risk company. You can use the Financial Times website to research other betas to build your own general knowledge. Betas will be given in the exam. When you're given a beta factor, you're going to put it into a formula to calculate the cost of equity. This formula is called the capital asset pricing model, and it assumes that investors can get a risk-free return by investing in government debt such as treasury bills, and then will expect a higher return when they invest on the stock market than they would get on treasury bills. And then how high a return they'll expect on a particular company will depend on the risk or the beta factor of that company. So the B is the beta factor. So let's practice using the formula. It's probably worth just reiterating what the terminology means before we go into the numbers. So at the beginning of the formula, we're saying all investors will want a risk-free return. This is normally measured in the UK as the return on short-term government treasury bills. The government will definitely repay. So a shareholder will want at least that return, and then on top of that return, they'll want some premium to reflect the risk of holding shares. RM is the market return, and RM minus RF is the risk premium or the market premium. How much premium we want depends on the risk of a particular share, and as we've covered, that is measured by a beta factor. Now we can move on to lecture example 5. We're going to do plenty of practice using the formula for the capital asset pricing model, which is shown at the top of the screen. The formula is given. The model is seen to be a better and more stable way of analysing the cost of equity than the dividend-based approach that we've just been through, where we had to guess the growth rate. There is quite a lot of terminology that you'll need to get used to, and we'll see some of this in lecture example 5. So in lecture example 5, we've got the term market premium for risk. This is the difference between the return on the stock market and the risk-free return. So that's been given as 8%. And then in the requirements, we're asked to work out the required rate of return on a share and the cost of equity. And these are the same thing, just different terms for it. So in part A, we can put in the risk-free rate of 4, which is given, and we can put in the market premium, which is 8. The beta is 1.6. And equity beta is just the beta of a share. And we can put that in too. So the formula is given. You just have to remember that you do your multiplying before your addition. So 8 times 1.6 is 12.8, and only then do you add the 4 to get your total required rate of return of 16.8%. And then in part B, the cost of equity is exactly the same thing, it's KE. But in part B, we've got a beta of 0.8. Okay, so this time putting in the beta of 0.8, 0.8 times 8 is 6.4, then add the 4, and we've got a cost of equity in part B of 10.4. And this shows that shareholders will expect a different return depending on the level of risk that a particular company has, and we're now measuring risk with this very important concept of a beta factor. The capital asset pricing model, as a method of calculating the cost of equity, also has some drawbacks or assumptions. It will come up with one figure for the required return. Now, even if that number is correct, so we had a number of 10.4% in the previous example, shareholders will expect a 10.4% return over a certain period of time. If you invest their money over a different period of time, their return should adjust. The capital asset pricing model doesn't make any obvious adjustment for that. It will also rely on its estimates for the risk-free rates and for the market return. The beta factor is a measure of how a company's share price has moved against the stock market over the past 5 years. This beta will change if a company's strategy changes. So if Ryanair decided not to be a low-cost airline anymore, then its beta factor would move. Finally, there are more comprehensive models that you need to be aware exist, but do not need to know the details of. And right at the beginning we said shareholders will build portfolios. Well, some don't. And if they don't because they're risk-seeking, then the capital asset pricing model will not be appropriate. In this chapter we also look at the cost of preference shares because we discussed them at the beginning of the chapter. But remember, preference shares are not equity finance. Nevertheless, if you're thinking about using preference shares, you'd want to estimate what they cost. You're given a formula which is very similar to the one that we used for ordinary shares earlier in the chapter. The only difference is that there's no growth in here, because with preference shares you get a fixed return. So if we apply that to the lecture example, £12% preference shares with a nominal value of £1 will be paying a dividend of 12 pence. If preference shareholders are prepared to pay £1.25 for the preference share and they know that they're getting a 12 pence return, then they must be happy with the return of 9.6%. So this is the cost of preference share capital. In this chapter we've started to look at some formulas. Most of the formulas were given on your formula sheet. For many people, as you start to look at formulas, it's a little bit worrying. Remember that we'll practice these formulas a lot as we go through the course. For the moment, as long as you're comfortable that we need to know the cost of equity before we decide whether to use it, and that you can do the basic lecture examples, then that's fine. Later in the course, we're going to use the cost of equity to work out a cost of capital, and that will help us to do a net present value. But don't neglect the discussion areas. And in section 1 and section 2, we talked about the types of equity finance and the methods of raising equity finance. And one of the really important issues in here was a rights issue and how it can be designed and the impact it can have on shareholder wealth. Now let's turn to the question and answer bank at the back of your course notes and have a look at a fairly recent real exam question. So don't worry if you find this challenging. You're not expected to be at the level of the real exam just yet. But still, it makes sense to practice questions, and using past exam questions at least gives you an idea of where you're trying to get to. The question that you should turn to is called Dan. Spend a few minutes reading the question through. If you prefer to have a go at this question by yourself, that's fine. Obviously, don't be too worried about any mistakes that you're making at this point. However, you might prefer to do this question gradually in part following the debrief that we're going to work through. In this question, you can demonstrate your understanding of the capital asset pricing model. And this is basically what's covered in requirements A and B, which total 15 of the 25 marks. So let's start with this section. In requirement A, we're asked to do some calculations. And we're asked to calculate risk and return
of an equity investment portfolio. So let's have a look at what the portfolio will be. The portfolio will consist of equal amounts of money invested in entity A and entity B with £40,000 that we've inherited. We're given some details about both of these entities in terms of their beta factor, although the beta factor for entity B isn't given. Before we analyse the portfolio, we need to note that there's a 2.5% transaction charge when we buy the shares. 2.5% of 40,000 is 1,000, and that leaves 39,000 to split equally between entity A and entity B. And in addition to these new shares, we also need to recognise that our portfolio currently consists of £100,000 of shares, which have an overall beta of 1.2. So let's analyse this portfolio. The analysis that we're performing needs to calculate the risk and the return of the portfolio. We'll then go on to talk about the issues in Part B. Okay, so we know we've got the existing portfolio and the new investments in entity A and entity B. So the first thing that we can calculate is the percent of our portfolio that consists of each of these elements. So first of all, 100 over 139 is 72% of our portfolio, is in our existing portfolio of £100,000, and then the other 19,500, so 19,500 over 139, gives me 14% of my portfolio in entity A and entity B. Now that I know the weightings, all I need to calculate is the risk as measured by the beta factor and the return. Apply those weightings and I'll have the answer to Part A. The beta factor is given for the existing portfolio and it's given for entity A, and actually we can calculate it for entity B because using the capital asset pricing model we know that the return that's being delivered is 15.8, and with a risk-free rate of 5 and an expected return of 11, so 11 minus 5 gives me 6, then I can work out the beta factor as the balancing figure. So subtracting 5 from both sides and then dividing by 6, that gives me a beta factor of 10.8 divided by 6, and that's 1.8. And then taking a weighted average and just multiplying through the beta factor times 0.72, the beta factor times 0.14, beta factor times 0.14, that gives me the overall beta factor for my portfolio of approximately 1.26, and that's my risk. And in fact, once I've got that beta, the quickest way of working out the return is just to pop the beta factor into the capital asset pricing model, and that will tell me that the return I expect from my portfolio is, so now using the beta factor of 1.26, that delivers an expected return of 12.56%. So the final bit of the question looks at two separate financial strategies. Let's look at entity A's first of all. Entity A is planning a rights issue, and we're given the terms in the question. Part C asks us to look at the implications of this for shareholder value first of all. An existing shareholder value is £2.50 per share. And we'll consider a shareholder who owns 4 shares, because the 4 shares are what you need to own to participate in the rights issue. So if you own 4 shares, you currently have wealth of £10. Now looking at the situation after the rights issue, well, after the rights issue, you will own 5 shares. These shares will be slightly lower in value, probably, because you've issued the shares at a discount. So, imagining that there are only 4 shares in issue, the 4 shares in the past were worth £10, the company now has £2 of the shareholders' cash as a result of the rights issue, and so there'll be £12 worth of value spread over 5 shares, which means that the share price, instead of being £2.50, will now be £2.40. So after the rights issue, shareholders will own 5 shares and each share will be worth £2.40. And so shareholder value will be £12, but we need to subtract the amount of money that they've paid in order to purchase the rights, and that means that their wealth is unchanged. And that's what you'd expect from a rights issue, unless the funds are going to be used to generate extra value for shareholders. We're also asked to address in the question whether this strategy would affect our decision to buy the shares in the first place, and clearly it might, because we're buying shares in a company that's about to launch a rights issue, and this is going to mean that we're going to have to stump up some more cash, which we may not have. So this is something that we would point out,